You're watching Bill on Bankruptcy. I'm Lee Pacchia. To my right, of course, is Bloomberg News bankruptcy columnist Bill Rochelle. Can't do the show without him. Be sure to go and read his daily bankruptcy column. It's available on BloombergLaw.com, and it's also on the Bloomberg terminal, of course. Bill, welcome.
Good day.
So, Bill, MF Global kicks us off. Creditors of MF Global took matters into their own hands when they filed a liquidating Chapter 11 plan. Was there anything surprising or amiss in the plan? Or I guess first we have to ask the question, I thought only the bankrupt company could file a plan. What's happening here? This is a troubling story.
You're right about that. Typically, only the company itself can file a plan, at least for 18 months. But in this instance, the MF Global broker is under the control of a Chapter 11 trustee. And Congress decided that once there is a trustee, anybody under his Aunt Martha can file a plan, and that's what the creditors did. What I find very interesting here goes along the following lines, Lee. Back in November, I wrote a story based upon some analysts who were calculating that the MF Global unsecured debt and notes were trading at maybe twice what an analyst thought was going to come out the other end of bankruptcy. Well, I said, well, so much, that's just one analyst's opinion. Maybe that's off the wall. Then, when a group of very sophisticated bondholders filed this plan for the MF Global broker, guess what? They came to the same conclusion. Their estimate about the recovery in Chapter 11 is pretty much the same, suggesting that the current trading value for the debt and bonds is about twice what's going to come out the other end of Chapter 11. Ergo, I am really interested to see what is going to happen down the road a few months when money starts going in the way of creditors. And, oh, by the way, these two revelations did not shake the market one little bit. The bonds are still trading well above 60, so other folks seem to think they have it better figured than the people I've been talking to.
And also, we have news in the Lehman Brothers case. It turns out the Lehman plan has a gotcha provision. No one noticed it at confirmation. What's it mean?
Well, I'm going to tell you, it really is a gotcha. You put it exactly right. There is a provision in the Lehman plan which says that if you receive a distribution check and you don't deposit that check in 90 days, you're out of luck. Money gone, you can't get it back, end of the road. Well, some pretty smart folks called Traxis Partners came back and said, listen here, we somehow didn't get our check. Well, the reason we didn't get the check, Traxis says, is because we moved, and I guess the money didn't get forwarded. So they want their nearly $200,000 back, and Lehman says no. That provision is in the plan. Nobody objected. The plan confirmation is final. End of story. I am very eager to see how Bankruptcy Judge Peck treats this because it really is an almost overnight forfeiture.
Moving on, we have news in Vertis. The marketing services provider is teaching a man in Florida how it can be rather expensive to disobey an injunction from a bankruptcy judge.
Oh boy, you can say that again. Vertis is a marketing services provider, and they have an approved sale to Quad Graphics. And by the way, it just closed for $170 million. There's this chap in Florida who has the opinion that Vertis was overcharging its customers. Vertis disagreed and, right or wrong, got an injunction from the bankruptcy court enjoining this chap from contacting customers. Well, in any event, this man in Florida says to the Vertis lawyers, I don't care if there is an injunction against me. I'm going to do what I'm going to do anyway. Well, Vertis went to the bankruptcy court and they got him held in contempt, where the bankruptcy judge is going to assess $5,000 in punitive damages for every instance of contempt that he finds. That's yet to be determined, but for some poor little individual who may not earn a whole lot of money, that is a mighty big hickey to take for shooting your mouth off when a bankruptcy judge has told you to keep quiet.
Bill, it seems these days we can't get through a week's show without discussing where the bankruptcy business is going to be heading in the future. We have some statistics to go through. What's the latest?
Still not very good. No, sorry, Bob.
It's never good.
Nope. The junk bond default rate in the United States of America at the end of December was, get this, Lee, 3.2%. Not only is it low, it's lower than it was a month before. It went down by 0.4%. And the projections are for the junk bond default rate to stay low throughout the remainder of 2013. And furthermore, as we've said before, there's only about $20 billion of junk debt that matures this year, and that is a mere pittance. So frankly, folks, I don't see an uptake among our brethren in the bankruptcy biz this year.
And finally, we have some advance sheets for you. A district judge in Chicago has the distinction of writing the opinion of the week. Bill, I gather from the story that you question whether the opinion is correct.
That is exactly right. Fascinating decision out of the Northern District of Illinois in Chicago. The district judge applied, and I'm sorry, Lee, for all of the technicalities here, but this is for our lawyer friends. The district judge imposed the appellate standing rules, which require a direct economic interest, to standing in bankruptcy court. The statute about standing in bankruptcy court says you can either be a creditor or party in interest. But if I'm reading this decision correctly, it says that in addition to that, you also have to have a direct economic interest in the dispute. Frankly, if this is applied at the bankruptcy court level, there may be many times in which, for instance, unsecured creditors will not be affected in the least by something being transacted with secured creditors, and therefore, do they or do they not have standing? This is a case which, by the way, if you were on the side of trying to beat standing, is a case you very much should cite, and we'll see in the next few years whether it has any legs or whether it's ignored.
All right, Bill, thanks for that. That's what we have for this week. If you'd like to learn more about the cases and issues we just discussed, be sure to go read Bill's column. It's available on BloombergLaw.com, and it's also on the Bloomberg Terminal. It goes into all this stuff in much more depth. You can see more of our videos on YouTube, and you can follow our updates on Twitter. I'm Lee Pacchia. Thanks for watching. See you next week.